Right now we're going to look at overhead. Basically, what is it, and then how do we account for it? This video is going to be a little bit longer than some of the other ones. So, what is overhead? Right. So, really, I should be saying what is factory overhead, and that's really the key concept to remember. It's the indirect product costs, so indirect materials and indirect labor, and then the factory related costs. And so how do we account for overhead? How is it that the costs related to actually having a manufacturing facility and these indirect costs that are necessary but aren't directly traceable to a product, how do we make each product bear a portion or share part of the total overhead cost? Well, we're going to look at the actual factory overhead account. And so on the debit side, what we are going to accumulate are actual costs. So every time we pay some type of factory overhead cost, when we get the bills for these factory overhead related items, we're going to put the actual bills in the actual cost side, so on the debit side. And then as we're going through production processing, we're going to credit the overhead account for the amounts applied to jobs. So these actual costs, what are they? Indirect materials, indirect labor, and then factory related costs. So to look at some of these a little more specifically, indirect materials would be things like glue, staples, sort of these minor product costs. So if you're looking at sneakers, you might see the leather and you see the laces and you might see the stitching, but there's a sole and maybe the sole has some glue and maybe there are some other sort of necessary but sort of trivial pieces of material that are required to manufacture the product. Those would be considered indirect materials. Indirect labor, so the direct labor are the people actually working with the physical product. The indirect labor would be the supervisor or the quality control folks. Then the factory related costs are all things related to having the factory, the rent on the factory, the utilities inside the factory facility, depreciation of the factory building and all of the machinery and equipment, insurance on the factory. So we've got this factory overhead account. We put the actual amounts as we get the property tax bill for the factory, as we're paying for insurance and electricity, and we're recording depreciation. We're putting all of these debits, right, into factory overhead and accumulating them on the debit side. And now, how are we going to charge a share of these costs to the different jobs? Well, we're going to determine what we're going to call a predetermined factory overhead rate. Pre as in beforehand. So these are going to be based on estimates. So first, at the beginning of the year, the accountant has to estimate the total overhead cost for the year and then estimate the total activity. And activity is not output. So this is not a how many units are we going to produce this year. It is based on a driver activity. And so depending on the kind of manufacturing environment you're in, the driver activity could be something like machine hours or direct labor hours. Whatever is the activity that seems to drive your costs the most would be a better selection for the activity driver. So let's look at an example. Let's say we've estimated that there will be $100,000 of overhead cost next year and that we are going to experience 20,000 direct labor hours. And the labor is sort of the driving activity behind the overhead cost. So to figure out the predetermined rate, right, that $100,000, that's us saying we're estimating those total costs on that debit side of factory overhead are going to be $100,000. And then the 20,000 direct labor hours is how we're going to apply the costs. So $100,000 of estimated total factory overhead divided by the 20,000 hours gives us an applied rate of $5 per direct labor hour. So factory overhead, right, costs on the left, applied on the right. What we're hoping for is that after we've done all of our manufacturing over the course of the year, if we were perfectly able to see into the future, we would have estimated those costs exactly $100,000 of costs and exactly 20,000 direct labor hours. We would apply everything perfectly and we'd end up with a zero balance in overhead. Unfortunately, it doesn't almost ever work out that way. So in the cases where costs end up being a little higher than we anticipated, then costs are greater than the applied, then we would have under applied and there would be this leftover debit balance in overhead. In situations where costs end up being less than the amount that we've applied, so our predetermined rate wasn't exactly right because we can't predict the future, and so we have an over applied, right? Our costs were actually less than the amount we charged to the different jobs. It almost always happens that there is an under or an over applied, and the way to get rid of that balance is to put it into cost of goods sold. And that's some of the basics of handling overhead accounting.